You've heard the debate 1,000 times: growth versus dividends, SCHG for capital appreciation, SCHD for income. Most investors think you have to choose one strategy and stick with it forever. But here's the truth that they don't want you to discover. The most powerful portfolio strategy isn't choosing between SCHD and SCHG. It's understanding exactly when and how to use both together. This isn't about diversification for diversification's sake. This is about a strategy that tactical investors have been using quietly for years to crush both pure dividend portfolios and pure growth portfolios. When I dug into the institutional data and ran the numbers across multiple market cycles, what I found completely changed how I think about building wealth. The investors who figured this out aren't debating SCHD versus SCHG. They're strategically deploying both, and their results speak for themselves. Let me show you the dividend strategy they don't want you to know about. Disclaimer: I'm not a financial advisor. This is for educational purposes only and is not financial advice. Always do your own research before investing. Let's dive in. Here's the narrative you've been sold. Pick your lane. Either you're a dividend investor focused on income with SCHD, or you're a growth investor chasing appreciation with SCHG. Think you have to pick one. Think again. Believing this myth has cost investors tons of missed opportunities. Let me show you what actually happened. From 2011 to 2021, SCHG led the way, delivering strong growth year after year. Growth investors were ahead, while dividend investors enjoyed steady payouts. Then 2022 hit. The market stumbled and interest rates rose, and SCHG took a big hit, while SCHD held up much better. By 2023 and 2025, growth bounced back with the tech rally, giving SCHG a big boost, while SCHD kept delivering steady but unspectacular returns. Before we dive deeper, let's make sure you understand what we're actually comparing. SCHD, the Schwab US Dividend Equity ETF, tracks the Dow Jones 100 index with 103 holdings of high-quality dividend payers. It requires 10 consecutive years of dividend payments and screens for financial strength, profitability, and sustainability. The current yield sits around 3.85% with an expense ratio of just 0.06%. It's heavily weighted toward value sectors like energy, financials, healthcare, and consumer staples. SCHG, the Schwab US Large Cap Growth ETF, tracks the Dow Jones Large Cap Growth Total Stock Market Index with 236 holdings of large cap growth companies. It focuses on companies with strong growth characteristics and yields around 0.5% with an even lower expense ratio of 0.04%. It's heavily weighted toward technology, communication services, and consumer discretionary. These aren't just different funds, they're different philosophies. But here's what nobody tells you. These philosophies are complementary, not contradictory. Here's the first problem you should know before using this strategy. Market conditions shift, and each ETF shines under different circumstances. When interest rates fall or stay low, investors start moving out of fixed income products and into assets with stronger total return potential. That's where high-quality dividend payers like SCHD can gain attention, and where growth stocks like those inside SCHG often accelerate because lower rates boost valuations and business expansion. If you only held SCHD, you missed the explosive growth waves from 2021 and 2025 tech surge. If you only held SCHG, you probably felt the painful drop in 2022 and missed the consistency and stability SCHD continued to provide. The brutal truth is, you're making a timing bet whether you realize it or not. Choosing only SCHD means you're backing that value, and dividends will outperform going forward. Choosing only SCHG means you're backing that growth will continue dominating. I didn't just pick one. I built what I call a regime adaptive portfolio. When I want an income-first approach, I go 70% SCHD and 30% SCHG. That way, I get steady income and stability, but still catch growth when it runs. When I want a balanced strategy, I split it 50-50 between SCHD and SCHG. It feels like the best of both worlds, income and growth working together. And when I'm focused on growth, I flip it to 30% SCHD and 70% SCHG. I'm chasing appreciation, but keeping a dividend foundation to soften the downside. The key insight here is, I'm not abandoning my primary strategy. I'm ensuring it against the market conditions where it underperforms. Here's what shocks me. When you run the actual numbers on total return, including dividends reinvested, SCHD and SCHG have been closer than you think over full market cycles. SCHD, since inception in 2011, has delivered approximately 12% annualized returns. SCHG, since its inception, has delivered approximately 14 to 16% annualized returns. But here's the catch. Those numbers include very different paths to get there. SCHG gives us strong growth during bull markets with severe drawdowns during corrections. SCHD gives us steady appreciation with much smaller drawdowns and consistent income. The mathematical reality is that a portfolio that captures 85% of SCHG's upside while avoiding 50% of its downside will often produce superior risk-adjusted returns over time. That's exactly what SCHD and SCHG blend portfolio can deliver. Think about it this way. Use SCHG for growth during expansion and SCHD for stability during uncertainty. A 60% on SCHG and 40% on SCHD split historically captures most of SCHG's upside with significantly reduced volatility. The psychological ability to stay invested improves dramatically. I use SCHD's 3.85% yield as my reinvestment engine to buy more SCHG during market weakness. When SCHG drops 20 to 30% in corrections, my SCHD dividends buy growth at discounted prices. This is dollar cost averaging on steroids. Here's another beautiful strategy I use. I rebalance between SCHD and SCHG annually. When SCHG surges, I trimmed it to buy SCHD. When SCHD outperforms, I sell some and buy SCHG. With this strategy, I'm systematically buying low and selling high between two proven strategies. Here's the reality nobody wants to admit. Your investment strategy should evolve as your life evolves. A 30-year-old with 35 years until retirement has completely different needs than a 60-year-old 5 years from retirement. If you're young and only own SCHD, you're prioritizing income you don't need yet while sacrificing the growth that compound interest could deliver over decades. If you're approaching retirement and only own SCHG, you're taking unnecessary volatility risk when you should be building a reliable income stream. When I think about my own accumulation phase at my current age, I allocated 75% SCHG and 25% SCHD. I'm decades away from needing income, so I want to maximize growth while still keeping a small dividend foundation. That SCHD slice gives me a little psychological comfort during market dips without slowing my long-term growth. Then during my retirement phase, I will do a 50-50 split between SCHG and SCHD. With this pattern, I'm no longer just chasing growth. I'm building a meaningful income stream while still letting my portfolio grow. And as retirement gets even closer, the income from SCHD becomes even more important. It's the part of my portfolio that quietly keeps delivering, letting me focus on growth where it makes sense. Let's look at the numbers that institutional investors analyze, but retail investors rarely see. SCHD and SCHG have a correlation of approximately 0.75 to 0.80. They move together much of the time, but diverge during critical market inflection points. That divergence is where the thing happens. When growth crashes, dividends hold up. When value struggles, growth often compensates. During the 2022 market crash, SCHG took a hard hit, dropping around 30 to 32% from peak to trough, while SCHD held up much better, dipping roughly 15 to 17%. A 50-50 mix of the two wouldn't have fallen as sharply, likely closer to mid-20%. That kind of difference can be the deciding factor between panicking and selling or staying invested through the storm. Looking at sector diversification, SCHG is concentrated in growth sectors with approximately 47% in information technology and 14% in communication services. SCHD, by contrast, emphasizes more stable, income-generating sectors, with roughly 19.5% in energy, 18% in consumer staples, and 16% in healthcare. Together, these ETF provide broad exposure across major sectors, balancing growth potential with defensive stability without overconcentration in any single area. Here's a key point many growth-focused investors overlook. SCHD's dividend has grown by around 10 to 11% annually over the past decade. Even if you're mainly chasing capital gains with growth stocks, that dividend stream compounds nicely. A current approximately 3.8% yield could realistically grow into a much higher yield on cost over time. If you reinvest, your income potential escalates year after year. The expense ratio story is beautiful. SCHD charges 0.06%. SCHG charges 0.04%. A blended portfolio costs roughly 0.05%. We're getting comprehensive exposure to both growth and dividend strategies for practically nothing in fees. Think about tax efficiency of combining these ETF. SCHD distributes qualified dividends, which are generally taxed at favorable long-term capital gains rates. SCHG primarily generates capital appreciation with minimal distributions until shares are sold. Together, they offer tax planning flexibility. In higher income years, we can emphasize growth through SCHG, and while in lower income years, we can strategically utilize SCHD dividends to optimize after-tax income. After market corrections, SCHG typically recovers faster during bull market recoveries due to growth momentum. SCHD provides better downside protection during the correction itself. A blended strategy gives you both: protection on the way down, participation on the way up. Let's be brutally clear. SCHD isn't better than SCHG, and SCHG isn't better than SCHD. They're different tools in your investing toolkit, each excelling in its own way. When you use both the right way, that's when the real magic happens. SCHD tends to shine when market volatility is high or corrections hit, providing reliable income and stability from high-quality, dividend-paying companies. It's especially attractive when interest rates are low, because investors seeking yield may shift away from low-paying fixed-rate options toward its growing dividends. SCHG, in contrast, performs best when interest rates are low and economic growth is strong, letting growth stocks run and fueling capital appreciation. The enlightened approach is to stop trying to predict which environment we'll be in. Own both. Let them work together. When one struggles, the other often compensates. Here's what the financial industry doesn't tell you. The debate between dividend investing and growth investing is a manufactured conflict designed to generate content, clicks, and trades. The reality is simpler and more powerful. Different strategies work in different environments. The investors who win aren't the ones who picked the right strategy. They're the ones who built portfolios that work in multiple environments. SCHD gives you quality, income, and stability. SCHG gives you growth, appreciation, and upside capture. Together, they create something neither can deliver alone. A complete portfolio strategy that works whether we're in a growth boom, a dividend resurgence, a bull market, or a bear market. Start today. Keep or build your SCHD position. It's your income engine and downside protection. Maintain your SCHG position at a level appropriate for your age and goals. It's your growth driver and wealth builder. Reinvest all dividends from both. Let compounding do its work across both strategies. Rebalance annually to maintain your target allocation. Stay invested through all market conditions. Here's the part everyone is missing. Let me walk you through what really happened to investors who leaned fully into this strategy versus those who didn't. In 2020 and 2021, growth stocks were on fire. SCHG investors were riding that wave hard, posting strong gains in 2020 and another strong run in 2021. It felt like every tech-heavy portfolio was doubling in size, and honestly, they had every reason to celebrate. Meanwhile, SCHD investors were having a very different experience. In 2020, they saw steady but much calmer returns, nothing explosive. Just a slow and sensible climb. Then in 2021, SCHD picked up more momentum, delivering a surprisingly strong year, but still nowhere near the surge the pure growth crowd enjoyed during that tech boom. So yes, growth investors felt like they cracked the code, and you can't really blame them. But that gap didn't stay the same for long. Then 2022 hit like a freight train. The Fed began hiking rates aggressively, and growth stocks got crushed. SCHG plunged down about 31 to 32%, and many growth-only investors felt like their portfolios were unraveling. Some panicked and sold. Others held on, but it was a rough ride. Meanwhile, investors who split their allocation between SCHD and SCHG had a very different experience. Yes, they missed out on some of the upside from 2020 to 2021, but they also avoided the full brunt of 2022's crash. With SCHD only down around 3%, a 50-50, SCHD-SCHG mix would have likely fallen by around 17 to 18%, rather than 30%, making the drawdown more manageable. That might not sound like a huge difference until you realize what it means psychologically. The difference between being down 25% and down 35% is the difference between gritting your teeth and staying invested versus panic selling and locking in losses. The blended investors stayed calm, kept reinvesting dividends, and positioned themselves perfectly for the recovery. Here's what happened next. In 2023, growth came roaring back thanks to the AI wave. SCHG exploded higher, delivering one of its strongest years ever. And the investors who blended SCHD with SCHG captured a big part of that rebound because they still had meaningful exposure to growth. But SCHD investors saw something different. After watching growth outperform in 2020 and 2021, they now had to watch it outperform again in 2023, 2024, and 2025. They sat through the boom, the crash, and the rebound, but missed out on the rebound twice. Here's the real kicker. When you look at the total returns from 2020 all the way through 2025, every surge, every correction, every rebound, the blended portfolio ends up landing surprisingly close to the results of pure SCHG. The difference is in the experience. The blended strategy delivered those long-term gains with far less volatility, far fewer stomach-dropping moments, and a lot more peace of mind. That's the whole advantage. You keep most of the upside while dramatically reducing the downside pressure. Let's talk about something that's even more important than the numbers. Your behavior. The best investment strategy in the world is worthless if you can't stick with it through market turmoil. And here's the formula of pure growth investing. Most people can't handle it psychologically. When SCHG drops 30% in a year, your brain goes into panic mode. You start questioning everything. Should I sell? Should I wait? What if it drops another 30%? The emotional toll is massive, and emotional decisions ruin wealth. Study after study shows that the average investor significantly underperforms the market because they buy high out of greed and sell low out of fear. Now imagine you have a blended portfolio. When SCHG drops 30%, yes, it hurts. But your SCHD position is only down 15% and is paying a 3.85% dividend that just landed in the account. That dividend is real money. It's tangible. It reminds you that your portfolio is still working even when prices are falling. The psychological comfort of that dividend income during market crashes is worth far more than any spreadsheet can capture. I've talked to countless investors over the years, and I can tell you this. The investors who stay invested through market crashes are almost always the ones with some form of income generation in their portfolios. The pure growth investors are the ones who panic sell at the bottom. It's not about intelligence or discipline. It's about human psychology. Income provides an anchor during storms. Think about it from another angle. Every quarter, our SCHD dividends hit our account like clockwork. Even if the market is down, even if portfolio values are falling, those dividends keep coming. That's 4 times a year. We're reminded that our investment strategy is working. Compare that to SCHG investing, where the only feedback is price movement. When prices are falling, it feels like everything is broken. With SCHD in the mix, you have concrete evidence that things are still functioning. People always ask me the same thing. Why not just switch back and forth? Go all in on SCHG when growth takes off, then flip to SCHD when value and dividends start leading. Sounds simple, almost too simple. Because if anyone could pull that off on a consistent basis, they wouldn't just be a good investor, they'd be a legend. The truth is, no one can predict those turning points with any real consistency. Not me, not you, not even the pros. The people who try to time these rotations always end up buying SCHG after it's already surged and buying SCHD after growth has already crashed. They're perpetually one step behind, always fighting the last war. By the time it's obvious that growth is dominating, most of the gains have already happened. By the time it's obvious that dividends are the place to be, the growth crash has already occurred. The blended strategy solves this problem completely. You're always positioned for whatever comes next. You don't need to predict whether 2026 will be a growth year or a dividend year. You don't need to guess when the market will crash or when it will surge. You own both strategies, and whichever one works will pull your portfolio forward. Think about the mental energy you save. No more reading endless market commentary trying to figure out if now is the time to rotate. No more second-guessing your decisions. No more watching other investors make gains in strategies you abandoned. You simply hold both, rebalance annually, and let the market do its thing. The simplicity is powerful. SCHD is legendary for quality dividend growth and downside protection. SCHG is exceptional for large-cap growth exposure and appreciation potential. But the real power isn't in choosing one. It's in understanding how they work together to create a complete investment strategy. Don't let anyone tell you that you have to pick one strategy and stick with it forever. The market doesn't work that way. Your life doesn't work that way. Your portfolio shouldn't work that way either. The investors who succeed long-term are the ones who build portfolios that can weather any storm and capture opportunities in any environment. The people who view this as a pick-a-side mentality end up chasing whatever just happened. They keep jumping between strategies only after the winning one has already played out. But the investors who combine SCHD and SCHG don't have to live like that. Their portfolios grow through different market cycles, no matter which style is leading. They worry less during downturns, they enjoy the upside during rallies, and most importantly, they stay invested because their setup is built to handle more than one type of market. This is exactly how I'm using both SCHD and SCHG. One drives steady income, the other fuels explosive growth. Together, they form a powerhouse portfolio that handles whatever the market throws at you, steady in a crash, explosive in a rally, and unstoppable over the long haul. I'm not recommending you buy any of these ETF. This isn't financial advice. I'm just sharing how I use them to give you an idea and hopefully inspire anyone interested in this type of strategy. SCHD just made a move that changes everything. You don't want to miss this. Check out the full video above. I'll see you over there.